This is a demand zone, why this is a supply zone. If you do not understand why, well, that's the more reason you should keep watching this video, because I'm going to show you how to identify high probability demand and supply zones and the trading strategy that works best with these kinds of zones. And by the way, this is the 7th episode of our technical analysis course on futures trading. If you've not seen the rest, do check the description of this video. So to get started, let's look at a simple schematics to help us conceptualize this, and then we're going to come back to the chart. So what exactly is a demand and supply zone? Ladies and gentlemen, a demand zone is an area or a price level on a chart where there is a buying interest from the big money. When I say the big money, I'm talking about institutional traders like the hedge funds, the banks, and large market participants. Of course, we cannot exclude the impact of retail traders, but theirs is just like a drop in an ocean. The emphasis is largely on the impact of the money from the big financial institutions. All right, so it is a price level on a chart where they have placed large buy orders. All right, and the opposite is the case for a supply zone. Supply zone is a price level on a chart where the big money, the financial institutions I had mentioned earlier, like the banks and the hedge funds, have selling interest. All right, so what happens here, okay, at the demand zone is that their orders, their buy orders, their buying interest, all right, would create an aggressive move away in price. All right, and this aggressive move away is identified by the formation of momentum candles. All right, candles like the Marubozus, all right, the different types of Marubozus. All right, so you would see bullish momentum candles here, bullish Marubozus forming here, a quick and an aggressive move towards the upward direction is one way to identify a demand zone. And for a supply zone, a quick and an aggressive move away from this region, all right, via momentum candles, bearish Marubozus, is a clear indication that you are dealing with a supply zone, ladies and gentlemen. So let's look at the structure. A demand zone would always have a base, all right, and then a region of aggressive upward movement, all right, as I said earlier, represented with momentum candles, bullish candles, while a supply zone would also have a base, right, followed by aggressive move away in price with bearish candles, bearish momentum candles. So let's see how this looks on a chart. All right, here on this chart, we can see that this is a demand zone, and the reason is because it fits the description I have been given so far. All right, we can see that this is a region of consolidation, and after the consolidation, we had a massive move away in price in the upward direction. This is an aggressive move in the upward direction. Can you see that we have momentum candles here, all right, in the upward direction? So the buy orders here from institutional traders are responsible for this aggressive move in the upward direction, the buying interest, all right, from the big money. And this right here is a supply zone, and the reason is because of these momentum candles. We can see here the red candles in the downward direction. We can see that we had a region of slight consolidation, and after that there was a drop in price. It bases out here. There was another drop, bases out here, all right, another drop, ladies and gentlemen. So now let's look at the structure I was talking about earlier on. We can see that for a supply zone, you would have a base, all right, and then after that you will see a drop, and then this region is the base, all right, this region is the base. The base can be made up of a number of candles. For this case, we have 3 green candles. So sometimes you would see a base and then a drop, then a base, a drop. So after a consolidation or a base, it drops with a momentum candle, bases out, drops with another momentum candle bases out, and it could continue like that. Now we need to point out that not every region or zone qualifies as a demand or a supply zone. So watch what happened after the drop to this level. There was a period of consolidation, and after that we saw a bit of movement in the upward direction with small big candles. All right, in my opinion, I wouldn't consider here a demand zone. All right, and then as you can see what happened here, there was a choppy move in the upward direction. The candles are not big enough, so I would not consider demand zones. I don't see any demand zones up here, right? So, and the same is the case for this region. We saw a drop from here to, we got to this point. So from here we can see that the candles were very small, choppy moves, all right, and a downward move with just a small sized candle. So I wouldn't consider this a supply zone. All right, but can you see what happened around here? There was a selling interest, all right, which led to this drop with a momentum candle. So I'm pretty sure that you understand what I'm talking about. All right, another example would be all of these candles here, right? Can you see these were just choppy moves? The candlesticks are not big enough to qualify them as demand zones. All right, can you see the choppy moves in the upward direction? The candles are small. Look at this. The first candle was big, but then the sizes of the candles were dwindling. I wouldn't really consider this a demand zone. All right, but notice what happened here. This obviously is a supply zone, and the reason is because of the aggressive move away in price. We can see that the drop was with momentum candles, bearish candles. All right, and there was a drop, ladies and gentlemen. So I'm pretty sure that with this explanation, it should be easy for you to clearly see these zones on a chart. Now the question is, how do we draw a demand and supply zone on a chart? Let's go to the previous region and show you how to do it. So there is no right or wrong way of doing this, but there are a number of ways that traders mark them out on any chart. All right, so I'm gonna show you the first way. All right, the first way is to use a pivot candle, and what I mean by a pivot candle is to use the last candle before the aggressive move. All right, before the formation of the momentum candles. In the case of a demand zone, the bullish momentum candles, and in the case of a supply zone, the last candle before the aggressive drop in price or decline in price. All right, so let's do this now so you see what I'm talking about. Let me delete this. Let's have all of this deleted so you can see what I'm talking about. So let's pick our tools. So I'm gonna pick this. So I'm going to pick the high and the low of that pivot candle. Right, this will be one way to mark out that demand zone. So notice what I did. What I did was just to use my tool, mark out the high and the low of that pivot candle. All right, so this right here would serve as my demand zone. And then of course, if I want to mark out my supply zone here, I will just pick that last candle there before this drop. All right, and that would be something like this, picking the high and the low. Remember, so you pick the high and the low of that candle, ladies and gentlemen, something like that. Now another way of marking or drawing a demand or supply zone would be to pay attention to the base, all right, and pick the high and the low, all right, of the base. And what I mean by that is like pick the highest wick, all right, in the upward direction, and then pick the lowest wick in the downward direction, and then mark out that region. So let me show you what I'm saying. Like if I want to do that here, so I'm going to just you can see we have 3 candles there. All right, so notice what I just did. All right, so I kind of picked the highest wick and the lowest wick. Yeah, so this would be a perfect drawing. All right, so some people would use the pivot technique, all right, that I showed you earlier before the drop. All right, if I want to do that in this case, that means I would have to use that doji there. All right, Okay, so there is really no right or wrong way, but one thing to bear in mind though is that when marking out your zone, so I could have it like this instead of the previous one I did, that is considering the entire base, right? So you can use the pivot candle, or you consider the entire base, right? But one thing to bear in mind is the bigger your zone, the more it affects your risk to reward ratio. That's very, very important. All right, so sometimes it might be necessary to make your zone as tight as possible. Sometimes you have to kind of increase it a little bit. All right, why are we learning about demand zones, demand and supply zones as technical analysts? What are we expecting from these zones? Well, let's look at this example here. Here is a demand zone. All right, and we can see price starts from here, drops to this level, bases out, and moved aggressively upwards towards this direction. All right, now what we are expecting, all right, is for price to drop back to this demand zone, ladies and gentlemen. And after the drop to this demand zone, the another expectation is for price to move upward, to reject from that direction. So as a technical analyst, what you are expecting is for price to drop to the demand zone, and then you would buy from this region. So why do we expect price to come to this region and reject? Well, the answer is pretty simple. If there was a demand, or if there was a buy order from institutional traders, when price starts dropping and coming back to this zone, they would like to re-enter the market from this region again to prevent price from crashing below this level, right? Because they have orders here, they wouldn't want to run into losses. So you and I, being retail traders, can just follow the footprints of institutional traders in the market. Once you spot where they have their footprints on the chart, you can either place a buy or a sell depending on whether you are dealing with a demand or a supply zone, right? So I want you to also have in mind that this would not always play out. Sometimes demand zones would fail. So this is going to take us to the next concept, which is the concept of what constitutes, or what are the things that make up a quality or a high probability demand and supply zone. Before we go into that, let me show you a bearish scenario. So for a supply zone, this is our expectation. First, we can see price starts by moving in the direction, ranges for a little bit, forming the base here, and then moves away with momentum candles, and then retraces, pulls back to this supply zone right here. So our expectation is for price to reject from that region, for price to kind of reject from that region and move away like this, ladies and gentlemen. So that's what we expect from a supply zone. This is the opposite of what we had for the demand zone. Don't forget, this will not always hold. All right, but there are certain things that would indicate a high likelihood of this to play out. Now let's start with a supply zone. The first thing that makes for a high probability supply zone would be a supply zone that leads to a breakout structure. All right, I like to look out for this. It is not compulsory that you must always see it, but I like to look out for this. If it is present, it increases the probability of this playing out. All right, and the next thing is the presence of fair value gaps. If this aggressive move towards the downward direction has a fair value gap present, that's a very good thing. That shows me that price is definitely going to, or most likely going to, retrace to fill that gap. All right, very, very important. And the next thing is I like to watch out for a freshly formed supply zone. All right, a freshly formed supply zone. Now the next one I want to talk about is very important. I would always like to see that the zone is not mitigated. All right, so what do I mean by that? What I mean is from here, okay, we expect price to pull back to this zone. All right, like this, we expect price to pull back to the zone. When price pulls back to the zone, this is already mitigated. What do I mean? What I mean is I would like price to create structural liquidity somewhere here. All right, that tells me that my zone is protected. So what I'm saying is that I would rather have price come this way, create a structural liquidity like this, and then move out like this. So you can see we have structural liquidity, then drop back into this zone, creating a sweep of liquidity. Can you see we have a sweep of liquidity? So there's a structural liquidity created around this level right here. So what do we expect now? We expect price to kind of move away from that region. So basically I'm saying that my zone must not be mitigated. The retracement must not touch the zone. All right, if it touches the zone, it makes it a low probability trade for me. That does not mean I wouldn't enter the trade, but it kind of reduces the probability or the chances of winning the trade. So my perfect setup would be something that looks like this. Price moves away, creates a fair value gap here, pulls back into that zone, and sometimes when price pulls back, you might respect that fair value gap and just push away from the fair value gap without even coming back to the zone. It happens sometimes, right? There are people who trade that once there's a pullback and watch the behavior of price around the fair value gap. If you don't want to enter that way, you might want to wait for a sweep of liquidity, because here now we have a structural liquidity. So you wait for price to kind of move below this, sweep this liquidity, and then you would enter from this region right here, and price would sell. All right, and for a demand zone, the schematics would look like this. So we have price dropping from here to here, ranging for a while. Therefore here is our demand zone, and we can see an explosive move towards this direction. All right, so for a high probability setup, I would expect a break of structure around this level, and I would expect this first pullback or retracement to not touch this zone. The moment it touches this zone becomes mitigated. All right, so I would prefer an unmitigated zone. So the first pullback has to move away without touching this, and then I would expect a liquidity sweep. All right, the next pullback to go below this, sweeping with the liquidity here. If you've not seen my video on liquidity, the concept of liquidity, do check the playlist section of this course. All right, I had a lot of interesting stuff unveiled there. Okay, so after the liquidity sweep, what do we expect? We expect price to start rejecting from this zone. So this would be my perfect setup. What time frame should we be looking for these setups? You can first start from a higher time frame. You might use the 4-hour time frame, you might use the 1-hour time frame. All right, the moment, let's say you started from the 4-hour time frame or the 1-hour time frame, and then you saw price approaching this after a sweep of liquidity, you might want to drop to a lower time frame and look for your entry confirmations. And your confirmations can be candlestick patterns, could be a combination of candlestick patterns and maybe indicators or whatever confluence or entry strategy you use, right? You might be asking, what entry confirmations should I be looking out for on the lower time frame or on the lower time frame, apart from candlestick patterns or chart patterns? Well, you could still be looking out for this setup. And then of course you can also pay attention to market structure. For example, price would not just come here and then boom, zoom off like this towards this direction. Price can move up a little bit, kind of create a higher low, right? You can see this low here is higher than this low, so that's a sign that price is probably going to start continuing in the upward direction. So and your entry would now be confirmed when you see this movement break this recent high here. All right, so that would be a change of character. Okay, so at that point you would consider entering the trade or buying from or longing from here, ladies and gentlemen. All right, let's look at how this plays out on a chart. We can see right here that we've got a supply zone from here. All right, I used that small red candle before this big bearish candle as my pivot candle to draw the supply zone, and we can see there is a pullback. So this green momentum candle, I used it as my pullback. Don't forget, your retracement or inducement can be a single candle, especially if you are on a higher time frame. So this is my inducement, creating my structural liquidity. So what do you think price did? Price went back down with that red candle and pulled back into this zone. Notice this first pullback does not mitigate this zone. It doesn't touch it, so it's unmitigated after the inducement. And then price went back to this zone, all right, breaking below this level right here. That's a sweep of liquidity. And when it came here, what do you see? You can see price rejected. Price started moving downwards. All right, you can see that anybody who caught this trade would have made a lot of money, right? Price kept selling even down to this place right here. So that's exactly what I'm talking about. All you need to do is to practice seeing this setup on any chart, all right, of any instrument you're trading. Another example would be this right here. So this is a demand zone example. So we have these momentum candles moving away from this zone. You can see a period of consolidation. So I've done my demand zone like this, right? So I just picked that first green candle, the high and the low of that first green candle, and drew this zone, all right? So majority of the wicks fall within that zone. So after that, we can see that there was a fair value gap here. So if you're wondering what the fair value gap is, well, it is the gap between this green candle, the shadow, the upper shadow of this green candle, and the lower shadow of the other green candle here. Can you see it? That gap there is my fair value gap. What does it tell me? It tells me that price is definitely going to come back to fill the gap in price. All right, it's definitely going to come back to this zone, and that was what happened. We can see this big drop in price from here to here, nearly mitigated this zone, all right, but it didn't because of the way I drew my demand zone. If I had shifted it up, it would have mitigated it, all right, but that wouldn't violate my trade. All it just does is makes it a lower probability trade. And of course, if you prefer the previous method of trading that I told you, I said that price could just come in here, and what you do from there is to just buy, and that was what happened. You can see price bought from here and went up. But for a higher probability trade, I wouldn't buy from here because I would consider this a structural inducement. So I would be waiting for price to come right back to sweep this inducement. That was exactly what happened. We can see price moved, came back down, went below this level, swept that liquidity, tapped into this zone, this demand zone, and what happened? Price started moving upwards, ladies and gentlemen, and we can see it kept moving upwards, If you want to see all the previous episodes of this course, just come to my channel like this, go to the playlist section, and click on this right here, this one, features trading from beginner to pro, and that's going to show you all the previous episodes, all right? So you can watch all of them if you want to understand what we are doing. See you in the next episode. Make sure you subscribe, turn on your notification, and share this video among your friends. Let's go.